Hey guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets, talking about some of the themes that could be affecting how things play out this week. So let's jump straight into it. We can start by taking a look at currency markets. You can see here the dollar index hovering close to recent highs, just above its 50-day moving average, and looks like it's probing for a breakout of this downtrend, which it's pretty much been in now. Well, I mean, it's been in a downtrend since last September, really. But this particular slightly slower downtrend, it's been in since last November. Of course, the most recent bounce comes in wake of a combination of dollar bullish factors, such as the recent strong jobs and ISM data, which has rekindled fears about the US economy being hotter than previously thought. But there's also been a lot of hawkish Fed speak as well. Like pretty much all of the policy members, not all of them, but a lot of them have been coming out and pretty much endorsing the idea that interest rates in the US should move above 5%. And, you know, this has had an impact on US bond markets, of course, which is why we're seeing the US two-year yields had this aggressive rebound recently. It looks like this could continue to push higher. It's breaking above resistance at the moment. It could potentially push back towards 4.8 if we're talking about the Fed going above 5% and then leaving rates there for a while. You know, when it was closer to 4%, that just wasn't consistent with that reality. And even at 4.5%, is a two-year yield at 4.5% consistent with the Fed's interest rate going above 5% and then staying there for a while? Probably not. We probably need to be closer to 5%, really. I mean, you can think that maybe within 2 years there will be some rate cuts, and we're not quite at 5% just yet. So it's not going to be over 5%. But anyway, it looks like there's potential further upside for this two-year yield, which could continue to lift the dollar. Um, so I'm thinking, well, actually, let me just show you dollar yen first, because this is potentially a lead indicator of what could happen with the Dixie. The dollar yen broke out of that downtrend, which the Dixie has kind of still in. It's above its 21-day moving average, which acted as support last Friday. Very strong reaction to the upside. Now we're breaking above the 50-day moving average, which previously acted as resistance. I mean, technically speaking, everything very much pointing towards a test of this support term resistance area at 134.70 or 134.80 sort of area up here. That's where I'm expecting this pair to go in the short term. And, you know, if that happens, if the 2 year keeps moving higher, then you're going to probably see the Dixie break higher as well. I mean, it looks like we've already got above the 50-day moving average. And the level you'd want to be looking at is this one around about here. 105, mid 105s, upper 105s. That's where you'd potentially be looking at. It's not a perfect support turned resistance, but because you can see those lows are actually down here. But it's a balance area. There's a lot of there was a lot of liquidity obviously in this area. Um, so that would be my target if we do get the confirmed breakout of this downtrend. Now, what could spur an upside break? Well, you know, upcoming on Tuesday, we've got US CPI coming out. Now, we're expecting an acceleration in the month-over-month rates of headline and core inflation here. I mean, you should be able to think that maybe that's priced in already because that's already what everybody's expecting. But if confirmed, it's just another piece in the puzzle. You know, strong jobs data, strong ISM services PMI, hawkish Fed, all of these things pointing towards the Fed's interest rate going above 5%. It's just another reason to think that interest rates going above 5% in the US. So it could sort of feed into this upside we're seeing in the dollar index and the upside we're seeing in yields. In terms of other asset classes, let's have a little look at stocks, which, despite the upside in yields, despite the upside in the dollar and the potential for more, stocks are doing pretty well still. Like we're only hovering about, I mean, how much below recent highs are we? We're only about 2.5% below the recent highs. And, you know, versus last year's lows, we're up, wow, 17%. Still up. Let's just have a quick look. What are we up on the year? Still up. Let's get it roughly. Yeah, about 6.5% on the year, which is pretty impressive. A lot of strategists I'm seeing. I mean, there was one. What was his name? Morgan Stanley's Michael Wilson, who's quite well known apparently. Um, him and plenty of others talking about how stocks aren't in touch with reality, basically, because the uh, earnings year over year earnings growth has already fallen to zero, and it's going to be an earnings recession soon. Um, and we're also looking at the Fed's interest rate going above 5%, yields moving higher. So are valuations, are these valuations at these levels, is that really justified? A lot of people worried that it might not be the case. Let's see if this week, I mean, if we did get an upside surprise on inflation, you can see stocks here trending higher within this short-term sort of trend channel, holding above the 21-day moving average for now. But if these support areas go, you could be in for a dip back below 4,000 in the S&P 500. That would be a reasonable area to expect. You'd have a test of this long-term downtrend, which we broke above last month. You'd have a test of the 50-day, 200-day moving average potentially as well. Um, I think, though, potentially, technically, that's a very nice setup to go long again in the long term. Because, well, let's see how things are playing out. Let's see how things are playing out. It does look like we're going to get an earnings recession no matter what, but the US economy, according to the jobs market and survey data, holding up better than expected. Maybe we can avoid a recession this year. Maybe inflation does come down fairly quickly still, even if tomorrow's date is a little bit ugly. A bit of a Goldilocks scenario, basically, that potentially that could keep stocks sort of lifted and lift us towards this August high. I still think that's doable. If we get the pullback, find support here, and then we could get up there. I mean, this would be over the course of a while, though. Maybe it would take us until May or until the summer to do such a move if we did pull back under 4,000 again. Anyway, that's a lot of ifs. Um, Subcritical oil, which is still within its recent range. I've been talking about recently how I think it's probably going to stay in this range because, you've got the dollar strengthening and you've got potentially a risk asset correction, which could potentially keep the lid on oil. We've also got concerns still about a bad growth outlook in various different parts of the world. Like, we're not sure about the US. Potentially, they can avoid a recession. Maybe they can't. We don't know. But then on the other hand, you've got the Chinese reopening. Um, and you've also had some other things like Russian oil output cuts, and OPEC's still there monitoring the situation. Uh, I mean, you'd think that they'd be wanting to put a floor under this if we did get a break lower. They'd come out with something. So, I mean, I quite like this range for now, playing this range. Um, Final asset class, we'll take a look at gold. If we're talking about yields moving higher again and the dollar moving higher again, well, I mean, we're going to be talking about potentially more downside in gold because gold is negatively correlated with all of those asset classes. A break below this 50-day moving average could open up a move towards the 1800 level. That's something I'd be looking out for. Potentially this week, you can get big moves in gold like we had earlier this month. Maybe something more to look out for the rest of the month. But in terms of what else we got this week, let's just have a quick look at Bloomberg's little key events summary. So today, a bit of Fed speak. Michelle Bowman, like I said, Fed speak recently has been leaning hawkish, talking about rates going above 4%. Bit more on Tuesday, bit more on Thursday. So smattering of Fed speak to be keeping an eye on. Obviously, US CPI is the most important thing from a macro perspective. But if you're trading if you're trading the pound or the euro, then you want to look out for UK jobs data, Eurozone GDP on Tuesday. We got the confirmation of the new BOGA governor on Tuesday as well, actually. But we already knew about the new guy. What was his name? Let's see if we can find it. Um, Ueda. And some people initially were thinking he was going to be hawkish. But one of the first things he said is excuse me, one of the first things he said is how he's going to basically stick with the same. Well, look, this is what he said. The BOG stimulus should stay in place. So for now, could potentially see further upside in dollar yen. Um, US retail sales on Thursday, that'll be important. That'll, in wake of the jobs data, the survey PMI data, um, that'll be another important input as to the current health of the US economy, which could shape expectations for whether we're going to see a recession later on this year. And actually, the way stocks have been acting recently, if this comes in strong, I mean, that could potentially support stocks by supporting the soft landing narrative. UK CPI on Wednesday, that's always important for sterling and the outlook for the Bank of England. Jobless claims out of the US on Thursday as well, Australia jobs. Um, and then on Friday, I mean, France CPI. Yeah, guess that'll be interesting for the Euro traders, but nothing really out of the US. So, yeah, guys, that's this week. Hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.